Tirthankar Patnaik joins in with his assessment of the market as well. He represents Religare Capital Markets. Good to have you on the show, Tirthankar. What's the view that you're taking on the market right now? You also are in the camp that believes that the market would perhaps be stretched in a broader range?
Well, our overall view on the market remains positive over a 6-month, 12-month perspective. Given the macro is turning around, there's no denying that markets will move up. But that said, the markets are likely to consolidate at these levels. They have remained so for about a month. And this is also because the macro recovery is not likely to happen fairly quickly. It's going to happen around FY16 or so. And what's also worrisome is the global overhang. The global overhang at this point could engender a risk of sentiment across emerging markets, and India could face some brunt of that. So that sort of makes our view slightly range bound, and the range is fairly wide at this point. But the overall stance remains fairly positive.
Tirthankar, the showstopper this morning has to be Tata Motors. They've come out with good numbers, impressive margin expansion. So post Q1 numbers, what is the way forward for Tata Motors?
Well, yeah, the margin has been just amazing. I mean, 400 basis points jump on since where they were last year. And clearly, even if you adjust for calculations done by other auto manufacturers globally, even then the margin numbers look fairly good. And especially China, with about 70+% YOY growth, and growth that is likely to even solidify going forward. Things are looking fairly good for Tata Motors. Our analyst has upgraded his target price to about 560 on the stock, and yeah, it's one of our top picks in the auto space. Clearly, things are going quite well for the automaker.
You're worried about the global situation and its impact on markets, emerging markets in India specifically?
I am very much. If you see in terms of growth, US growth, which a lot of us believe is the reason why the taper is happening, is the reason why the global economy is going to move forward, has been downgraded for 2014 from about 2.8, 2.9% to slightly less than 2% now, despite the second quarter jump of about 4% on a YOY basis in US GDP. We're likely to see the overall numbers come in at roughly about 2% for the year. And while 2014 numbers have been downgraded, we have not seen any kind of move up or a low base effect pan in for 2015 estimates, where we're likely to see about a 3% number. Our experience over the last 5 years tracking US growth estimates by major players, IMF, Fed and all, has been that you start out the year painting a fairly positive or hopeful a good expectant picture, but you realize that growth does not really come up, and you end up downgrading those numbers. 2014 has been no exception. Having said that, why is the Fed really tapering meaningfully? Our worry is that inflation numbers in the US have been picking up. They have been about 2% for the last 3 months now. Food inflation is going up higher. So the question is the Fed behind the curve? If they realize they're behind the curve, are they looking at raising rates faster? We believe that this overhang is likely to hurt the global markets over the next 1 or 2 months. From a markets perspective, US markets have been on a one-way trip. As has been widely reported, it's been almost 2 years since the US markets last saw a 10% kind of correction. So from a pure market behavior perspective, we believe that the US markets could take some money off the table, and that could in turn translate into a risk of sentiment for emerging markets as well.
Tirthankar, what has suddenly done the trick for Infosys? Change of guard or bargain buying?
Well, part of it is bargain buying as well. I mean, interest in the IT pack had practically gravitated away from Infosys towards TCS, towards HCL, Wipro, all the other large cap names, and this is where under ownership has come in and helped Infi. And of course, change in guard is something that's likely to now pan out over a couple of quarters. Our view has always been that IT is neutral, Infi is overweight, and which we'll maintain for now. We are positive Infosys, and that trade is working out quite well.
From the large caps, there is some aside of Tata Motors, there's some traction seen in cement as well, which as a sector, they do not see a directional move as of now. It's one day up, one day down, more range bound for these stocks. What's the view here, Tirthankar?
From a 12-month perspective, we believe that one of the plays in the recovery would be the cement space. Of course, in the near term, we've had problems about price hikes, people asking for price cuts, people the government suggesting that price hikes should not be to the tune of what it is. But needless, regardless, we are likely to see cement numbers going up. Cement volumes are likely to go up. Pricing power will come back into the system once the monsoon season gets over. Large cap valuations are nearing expensive levels. I think Ultratech is north of 10.5, 11 times EV/EBITDA at this point, and their bull case valuations have been around 14 odd times. We believe that Ultratech could reach those numbers. In the mid-cap space, we have been perennial, positive, having positive feelings about JK Lakshmi, JK Cement, and we would add, our analyst believes Birla and Orient Cement should be added to those names. Overall, cement we remain fairly positive. Mid-cap valuations will start inching up now, and this is one sector that we are overweight on versus the Nifty, and others, of course, we are overweight on pharma, we are overweight on energy. But yeah, cement we will remain positive over the next 12 months.
What about the recent run-up? Most of the cement stocks from the large cap space are up 40-50% in a matter of 3-4 months.
I agree, which is what I said. I mean, large cap valuations are looking stretched. More than north of 10-11 times EV/EBITDA is where large cap valuations are. That's where things stop being just reasonable. Things, since they are fairly priced, they might see now the emotion, the build up on the recovery right now. So historically, Ultratech has gone up to 14 times EV/EBITDA. We see it going up further. But like I'm saying, if you want to make alpha would be now made in the mid cap space, and which is where I lined out a number of cement plays.
Tirthankar, suddenly market men are no longer chasing PSU stocks like BHEL, BML, BL. They are not participating. They are not languishing, but they are simply consolidating. Do you think the zing in the PSU trade is over?
The zing in the PSU trade was over around elections. Nikunj, if you remember, you had asked me why is it that in our picks we don't have any PSU names, and if you see performance after May 16th, you take out the metal names and it's been all over the place. It's not just the PSU pack that has done well. In fact, PSU banks, I think practically money was made till the elections. Post that, people have just basically taken money off the table. What has really worked is if you have a good, clean, quality portfolio. Of course, playing India plays. You be in energy, you be in cement, and you're not underweight on IT. That stance would have worked out fairly well for you. And financials, our worries on asset quality remain. We have been highlighting that forever, and we are positive on private banks. But PSU, of course, I think I've already answered your question that the money was made till the elections.
The market was expecting for a while actually a possible rate cut, and now that there is indication that may not be in the offing over the next 6 months, what do you think will drive the market higher from here?
See, rate cuts we were not expecting it. I mean, it's hard to think that the RBI will serve us a rate cut when inflation numbers are still north of 7%. We will have the CPI, WPI numbers come in, and numbers are still 7.1, 7.2 is what we are expecting for July on the CPI levels. The RBI has fairly made it clear that it's not just 8% by January 15. It is the 6% target by January 16 that they are worried about, and they would rather face this battle once than face it again and again. We know that the central bank had to change its interest rate direction in after starting in May 12, and after May 13 after a year we had to actually raise rates. So the RBI would not want that. And our view therefore has been that if you are expecting a cut, it will not come before January, in the Jan to March quarter, and towards the end of it, you might not even rule out a hike if inflation numbers do, go back up after November. So clearly things are bad. But having said that, the direction of the market will remain positive. Why is that? Markets never, never disappoint you when growth numbers go up. And we expect that the 4.7 clip that we saw in FY14 is not likely to be, is definitely likely to be bettered. So we should see about 5.2, 5.3% this year, and FY16 should see even better numbers. Clearly, the credit cycle is playing its way through. Asset quality is likely to be a worry, but overall change that has come in with the new government, with people taking things more seriously on the investment front, are likely to be positive. Tailwinds for the market, just that it's not going to be a monotonic rise.
I've read your reports, you're bullish on Britannia.
Yeah.
As a house, are you still bullish on Britannia after the recent run-up?
Very much so. We remain positive on Britannia. We believe margins are likely to, not surprise so much as they have over the last couple of quarters, but yes, margins are likely to remain steady, and this company is going to do better going forward. So our analyst remains positive on Britannia. Other consumer names, our analyst is also getting positive on in the smaller space. Are Imami, that's one more. Bata, we were always positive. So consumption, some pockets of consumption are where we are positive. Overall, of course, we remain negative on consumption. We believe that valuations are stretched on the large cap space, and with such high interest rates, you're not likely to see consumption levels do very well this year.
What about HUL?
Okay, so HUL we've not got it right. I'm afraid, consumption theme, our negative view on the consumption theme has not worked well with HUL. More company specific factors, but company has done fairly well. We tried to play ITC over HUL, and that trade has not worked too well. ITC will remain positive. We believe that the pricing power with the company, remains despite the kind of tax overhang it is seen and it's likely to see over the next couple of years. But HUL, yes. What we are saying is the stock is likely to remain range bound for now. Maybe the best part of the money has been made. This is one of the stocks that has done very well post elections, and this is one stock we've missed.
What's your top bet among two-wheelers and four-wheelers?
Well, like I said, Tata Motors we like. Maruti is another stock that we really like. Amongst the four-wheelers, two-wheelers we like Hero Motors.
Tirthankar, at 7600 on the Nifty, if you have to construct a portfolio which has a shelf life of about 12 to 18 months, what would you like to buy into that portfolio? I'll keep the market cap constraint open, I'll keep the liquidity constraint open.
Okay, so from a large cap portfolio perspective, we would be, if I have a relative mandate versus the Nifty, I would be overweight domestic plays like cement, as I said, and we would be overweight energy. We believe that clearly the subsidy rationalization play over the next couple of quarters is likely to play very well for the energy space. So ONGC, GAIL, BPCL will be the stocks we'll be overweight on. Other than that, we remain overweight on pharma. Numbers have been very good, but numbers are likely to remain fairly good. Sun, Lupin will be the stocks that we'll be in. We are negative on consumption, as I pointed out. Doesn't matter, we missed HUVR, but that will be one space where we'll be underweight versus the Nifty. We are negative on telecom. We shall remain negative on telecom. Idea, Bharti are both where we'll be fairly negative on. Then in terms of the other large sectors, financials, we are neutral at best. Private banks are where we have a positive view. ICICI Bank, HDFC Bank are the stocks. Amongst the mid caps, Yes Bank, IndusInd Bank are the stocks that we like. And overall PSUs, therefore we will have a slight neutral to negative. SBI is one stock that we'll keep neutral, but the other PSU banks we will remain negative. And the other space is IT. IT will remain neutral. Large caps, I think our analyst says the good amount of money is made, but we sort of believe that currency headwinds are likely to be there. We will see headwinds for the currency, and overall IT should be a neutral, and Infy is one space where we'll be positive. So there I've basically summarized the portfolio. We'll also have about 10 to 14%, 10 to 15% on mid caps, where we have our picks. We have Britannia, Bata, as I pointed out. We have Gulf Oil. There are other stocks that we like. We like lubricants. We like stocks in the capital goods space. So that will be the portfolio from a 12 to 18 month. It is basically playing a recovery, but it is also taking cognizance of headwinds that this recovery will face, namely asset quality, namely delays in consumption.